And Alicia Levine from BNY Mellon Investment Management to this conversation as well. Alicia, I want to get your take on these retaliatory tariffs on some goods being imported from Europe and what it would mean for market moving forward.
So this is just another incremental negative for the market. And for most investors, they were not focused on the European tariffs at all. And to the extent that we really have not gotten anywhere with China, it does feel like a piling on and just an increasing of the negative sentiment, making it very, very hard for the market to move forward here.
Alicia, today with this kind of selling that we've seen, we should remind everyone, of course, down 494 points on the Dow. Was there anything that you were advising your clients to buy, any sector that looks cheap and sees this selling as an opportunity?
So eventually there could be an opportunity, but what we see is a really choppy market moving forward. It's one of those strange markets where it's really very dependent on macro data. So we have the ISM services number coming out tomorrow. We have the BLS number on Friday. And these numbers are really going to tell us whether the manufacturing slowdown here in the U.S. has pivoted over to what's really keeping the economy afloat, which is the consumer and the services section. And we actually need the data to see it. And when you have a market that's so dependent on signals like that, it's just very hard to invest. So we see more choppiness, more volatility, and we wouldn't be surprised to see the market move towards the 2,800 point and the tactical level just testing.
Josh, the market seems to be moving towards pricing in a greater chance of a rate cut at the end of this month. Do you think that happens?
So I think it does, only because of market direction, and that can change really quickly. But I really do believe that all the commentary, all the data that goes into the Fed decision, at the end of the day, they look at sentiment, and sentiment, the best possible measure of sentiment is the S&P 500. I do think the 200-day moving average factors into decisions, even if they don't say it out loud. There are a lot of Bloomberg terminals in the Federal Reserve building these days, much more so than there used to be. And actually, that sounds bad, but it makes sense. The stock, we reorganized the whole economy around the wealth effect. The wealth effect comes from three places. Did you get a raise? Is your house up in value? And how's your 401k doing? So it's not ludicrous to say that the Fed will look at what's going on in stock markets. And so I do think that we're moving closer toward that moment.
But the Fed also, in a data-dependent mode coming out of the last meeting, was watching for the pace of activity. And you get an ISM below 48, whether you think that number is magic or not, it's enough to say, fine, we want to probably try to get ahead of this, at least on, pending Friday's jobs number.
But Mike, is that enough now? With the sentiment already worsening and the momentum moving against you, is that enough to help the market kind of
Is a Fed rate cut enough?
Yeah.
It probably could incrementally be. I mean, look, again, we're not in a disaster mode right now. I don't think it matters that much. That 25 basis points doesn't really matter.
A couple of weeks ago, we might have had that cut with the data still looking strong.
That was the market's implicit bet coming into October.
Imagine a scenario where you get the rate cut and the market sells off anyway. That would be the only evidence you need that...
That's quite likely at this stage, is it not?
That would be July. That happened.
The global trade sit, that will tell you that the market is now fixated on whether or not the earnings estimates going out to 20 are safe because of not where rates are, but the international trade situation.
Alicia, I want to get you in on this debate. Who do you agree with and why?
So I think the Fed cuts again at 25 basis points, but money is already inexpensive and corporations can borrow. The issue is, do they want to, and do they want to expand? I don't think another 25 basis points is going to help the real economy all that much. We will wake up tomorrow morning with global yields lower, which will probably pull our 10-year lower as well. And that's a problem because then you kind of get this reinversion probably on the 210s, which is another recession signal. So the problem with the trade issue is that you're just pulling the long end down.